Hi, hello student. So today's we are going to discuss on a very important topic, which is the financial instrument in the Indian fixed income money market and the derivative market. So in this video, guys, we are going to learn about the financial instrument which are available in the Indian market. So where we are going to discuss what the definition of financial instruments and the purpose and operation of these financial instrument, and then we classified these financial instrument in their the duration or in the natures, like money market instrument, then the fixed income and debt market instrument, and the derivative instrument on the basis of their duration and their the nature of investment. Then we look at the Indian market infrastructure, where we are going to look at some key pillars in the Indian market infrastructure. Then we look at how the financial instruments are, in a perspective of treasury. Then we are going to look at the importance of risk measure in the financial instruments. What are the yield to maturity, modified duration, basis point, and then we look at the AML, asset liability management, and risk management view. So we will look all these things in a perspective of the financial instrument in Indian fixed income money market and derivative market. So guys, first I will we will discuss on what are the financial instrument. So guys, in the previous video, we are going to look at the financial market. So in the financial market is a place where the financial product, the trading will happen. Buyer will come to buy and seller will come to sell their the financial product. But that financial product is we called as a financial instruments which are be traded into the market. So a financial instrument is a contract claim representing a asset for one party and liability or equity claim to another party. So it is an asset for one party and liability to another party. And these instrument ranging investment, liquidity management, risk transfer, and policy diversion in the financial market. So on the basis of your objective, you can issue the financial instrument in the market. So we are going to in the next slide, what are the financial instrument, what are the types of that financial instruments, and the purpose of the treasury operation of the financial institutions to liquidity management, to invest of surplus fund. Obviously, if some party has the extra funds or the surplus funds, to invest that fund on the basis of their risk appetite or the risk tolerance level, or how much the risks they are going to take. So risk and return are the inverse things. If you want to higher the risk, the higher the return. But there is the portfolio optimizations and concentration risk part is comes. But let's discuss it now. It is not time to discuss this thing. So the funding requirements, and then interest rate risk management. So while the changing in the interest rate, so what is the impact on the portfolio? Then the foreign exchange risk management, and then we are going to look at the regulatory compliance, like statutory liquidity ratio, CCR, LCR, liquidity coverage ratio, net stable funding ratio, how these are the financial instruments are support these parts, and how different financial instruments are comes in these areas of regulatory compliance. So let's first discuss, guys, the classification of the financial instrument. So in this the classification, we are going to the three classification of financial instrument. First one is a derivative instrument, then the fixed income and the debt instrument, and this the money market instrument. So guys, money market instruments are the instrument which are traded for less than 1 year. So it's keep in mind, and use for it is the use by the financial institutions to purpose of the liquidity or the short term liquidity management. So to calculate the net stable funding ratio or the liquidity coverage ratio, to calculate how much the funding required, and accordingly they will issue the money market instrument, like the treasury bills, call notice option, tribes, commercial paper, certificate of deposit, and interbank terms. So these are the money market instrument that are issued in the market and to collect the funds to pursue the short term liquidity management. So the key participants in this area are the banks, the primary dealers, mutual fund, corporates, and the insurance companies are involved in this area. So let's move on to the next financial instrument, classification of financial instrument, which is nothing but the debt or the instrument or the fixed income instrument. So guys, you should understand the fixed income instrument are the instrument which will give you the annual coupon or the semi-annual coupon on your principal. So it's the fixed, it's type of also the floating rate of interest or the fixed rate of interest. So you invest the X amount of for certain period like 5 years, 10 years, or the 15 years on the basis of nature of that the fixed income instrument, and you will get the annually and the semi-annually your returns on these instrument. So provide the provident and the market link return. So it will generate the link return, and the instruments are traded in these areas: the government securities, state development bank, corporate state development loans, corporate bonds, PSU bonds, and the municipal bonds, and the sovereign green bonds. So all these instruments, all these the example of the class, the fixed income and the debt instrument, they are available into the market. So government securities are the securities where the government will issue the and that, so rate of interest is low. The state development loans are issued by the state player and they have the government guarantee. And then the corporate bonds, which is the more risky than the government bond. So public sector unit bond issue, they also issue the bonds, the municipal bonds, and all these things there. So key treasury objective of issuance of bob generate the return while maintaining liquidity and regulatory compliance. So they want to generate the returns and liquidity management things. So let's move on the next slide, guys, where we are going to discuss on classification of financial instrument. It is a third type. It is a derivative instrument. So here we are going to discuss on the derivative instrument, guys. So I have yeah, we will look at the I have make and the mistakes. So please keep in mind. So derivative is look like writing that. So derivative instrument. So use a primary for hedging, and it is used for the hedging and the risk management. So my analyst will do the its mistakes. So it's not an issue. So the primary use of to use the derivative instrument for the hedging and the risk management, because in the financial instrument there is always the risk to loss of the money. So that's why we use a derivative product to do the interest rate swap, forward rate agreement, currency option and future, overnight index trading, currency swap, and interest rate future. So these are all the financial instrument we use on the basis of what the financial product we have, and why we want to hedge and to do the risk management. So these are any one product we select according to the requirement and hedge this project with using the derivative product. So there is a call option, put option, there is the futures and options. So that's we hedge these the financial instrument for the purpose of the transfer the risks without transferring the ownership of underlying assets. So that's why we use the derivative product. So let's move on Indian market infrastructure. So what are the key players involvement the in this area for the financial instrument? Because there is the some organization, they are regulators, clearing corporation, timely settlement, order or all the things management, and the type parties management. So that's why these are the key pillars that is involvement in the financial market or the financial instrument traded between the different entities. So the RBI is playing the crucial role in the regulator for money market, GSEC market, and the rupee derivative. And it is conduct the operation and maintenance of VRR and SDF and the repo operation. So then the Clearing Corporation of India Limited, so CCIL. So it is an the body of the government which is taking care of the clearing of the settlements of between the two institutions. So central counterparty settlement, guarantee risk management through margin, and the collateral. This is the important role by the Clearing Corporation of India Limited. So NSD and Operation OM is the platform where the order management will happen electronically. So that's the electronic trading platform or generate the government securities fetching the transparent and anonymous order matching. So they do order matching, reconciliation, all these things will done in the NSDOM and the tri-party platform for operates by CCIL. So TREPS is a tri-party repo platform which is operated by the CCIL and major source of short-term liquidity and the market participants in these the Indian infrastructure for these the financial instrument. So let's move on the next slide, guys, where we are going to look at the treasury perspective, how the treasury perspective these financial instruments are look like. So the investment book, trading book, and the liquidity books are three different books that is managed and handled by the treasury department. So in investment book we will consider the GSEC, SDLCs, state development loan funds or the loans, and the corporate bonds are the investment books. And then the trading books, the active purchase sales and profit mark to market valuations were done. And the liquidity books are the T-bills, TREPS, and the call money will come in this part. So in the next slide, we are going to discuss the importance of risk measure. So guys, risk is always there in the financial instruments because the failure of the counterparty or unavailable of the sources of the funds or the different risks are the liquidity management, risk management, or the operational management. So let's discuss on yield to maturity YTM. So how to calculate the yield to maturity? So annual coupon plus face value, the price divided by the years plus face value plus face value plus the price divided by 2. So this will give us the yield to maturity. So it's half yearly. So then the duration. So measure the price sensitive to interest rate movement. So it is nothing but which is help us to measure the price sensitive to interest rate movement. So modified duration is the duration divided by the or sorry, duration or the product of the duration, modified duration, and the yield. So DV0 is a change in the portfolio value for 1 basis point in a moment of one yield. So if DB01, if we suppose change in the yield of the 1 basis point, then what is the moment of the portfolio value of the portfolio which changes? So that's we calculated in the DB01, and the basis means 1% means 100 basis point. So let's discuss on the last slide where we are going to discuss on asset liability management. So it is on the very important concept, guys, for the money market or the derivative market or the fixed income market to analyze the asset liability management in the risk management view. So the type of risks, there are the different types of risks like interest rate risks, liquidity risks, credit risks, market risks, reinvestment risks, and the counterparty risks. So relevant of these risks is the interest rate risks is related to the GSEC, IRS or the OMS operation in the risks, and then the liquidity risks is the tribes, and the T-bills, credit risks is the corporate bond, and the commercial paper, certificate of deposit that comes under the credit risks, and the market risk is the trading portfolio, how that portfolio will perform, and then the reinvestment risk is a long-term bond and the counterparty risk. So OTC derivatives. So these are all the things are involvement in the part of the risk management. So this is the end of this interesting slide, guys. If you are like my channel, so please do like and subscribe my channel so that motivate me to create and more such video, guys. So once again, thank you so much, guys.